Nobody wants to look up one day and realize their safe ETF plan has been leaking money for years. ETFs get sold as simple. Pick a couple of popular ones, hold them, and you're done. And honestly, they can be a great tool. The problem is they don't stop you from making bad moves. They make bad moves feel normal. I've watched people do everything that looks responsible on the outside and still lose money simply because they misunderstood how ETFs really work. So here's what I'm doing. I'm taking one $5,000 investment and following it through the most common ETF mistakes using real dollars so you can see how each decision amounts in real dollars. And in the end, I'll show you how that same $5,000 can either shrink to about $700 or grow to roughly $7,000, a $6,300 gap created by decisions that feel harmless at the moment. And it starts long before fees or returns ever matter. It starts with how people behave. This is the herd mentality. Herd mentality is what happens when seeing other people buy something starts to feel like evidence that it's safe. Especially when uncertainty is high. In investing, it creates a false sense of safety. If enough people are buying something, it must be the right decision. That's why many ETF investors believe they're being rational, even when they're not. One of the most damaging ETF mistakes is performance chasing, which is herd mentality in action. Investors don't buy because they've analyzed the ETF. They buy because the ETF is everywhere. Here's how it happens. An ETF starts rising, 30%, 40%. Articles start popping up. Social media fills with charts. Friends mention it. The more visible it becomes, the safer it feels. That feeling is the herd. A clear real-world example is the ARK Innovation ETF. Earlier in its history, ARKK paid small dividends, which made it feel like a legitimate long-term ETF. Today, it no longer pays a dividend, but investor behavior around it followed the same pattern. During 2020, ARKK surged as high-growth technology stocks took off. By early 2021, the ETF was up over 150%, and that's when most investors entered. Not before the run, after it. That is herd mentality in action. Investors weren't responding to valuation or risk, they were responding to visibility, social proof, and fear of missing out. Now, imagine putting $5,000 into an ETF that's already up over 150% and trading near all-time highs. It feels proven, widely owned, and almost irresponsible not to own. But that sense of safety is an illusion. When performance attracts attention, it usually attracts it late. Most of the easy gains are already gone. The ETF itself isn't necessarily bad. The timing is. With ARKK specifically, buying after that kind of run meant starting from a much tougher position. Based on current valuations after the surge, the expected drag was in the range of 10 to 13% a year. Not because the companies were worthless, but because so much optimism was already priced in. Historically, investors who chase performance underperform by 2% to 3% per year compared to those who stay diversified. On a $5,000 investment, a 3% annual drag works out to about $150 per year. After year one, that $5,000 slips to about $4,850. After year two, it's around $4,700. After year three, it falls to roughly $4,550. After year four, it's down to about $4,400. By year five, you're left with around $4,200. That's roughly $800 lost over 5 years, not because the ETF failed, but because of herd behavior. There's no crash, and that's what makes herd mentality so dangerous. It doesn't feel reckless, it feels reasonable. And once investors start following the crowd, the next step is usually worse: trend hopping. Trend hopping usually comes after herd mentality. Once investors fall behind, they don't slow down and rethink the strategy. They try to make the money back. Every market cycle has its trends: clean energy, innovation, crypto, artificial intelligence. The message is always the same. This time it's different. So after years of underperforming, that original $5,000 is now down to about $4,200. Instead of reassessing what went wrong, the money gets rotated into a narrow, trendy ETF that feels like the future. A real example is the iShares Global Clean Energy ETF. Clean energy was marketed as inevitable, policy-backed, future-proof, and safe inside an ETF. Investors piled in after headlines and strong past performance. Then expectations ran into reality. Over the last 5 years, ICLN has been down about 40%. Not from one dramatic collapse, but through a series of smaller declines that didn't feel alarming on their own. Here's how that plays out in dollars. You start with $4,200. After year 1, it drops to $3,864. After year 2, it slips to $3,555. After year 3, it falls to $3,270. After year 4, it's down to $3,008. By year 5, you're left with $2,520. That's a 40% drawdown spread over time. No single year feels catastrophic. Each step seems manageable, but stacked together, the damage adds up fast. Zoom out and the damage is clear. The original $5,000 is now worth $2,520. Nearly $2,500 is gone. That's half of the investment. Not because ETFs don't work, not because clean energy wasn't real, but because chasing trends at the wrong time can make falling behind into lasting damage. This is where many investors lock it in and cash in the remaining amounts to avoid further losses. After years of declines like this, panic selling becomes likely. When that happens, even a future recovery doesn't matter. You're no longer invested to benefit. But let's say you stay invested. And even investors who avoid trend hopping often make another mistake that keeps draining returns year after year. They ignore costs. ETFs are marketed as low cost, and compared to many mutual funds, they are. But not all ETFs are cheap, and most investors never bother to check. By this point, after herd mentality and trend hopping, your original $5,000 is already down to about $2,520. You're still invested, so fees feel like a minor detail. They're not. Take two ETFs that track the same index, the S&P 500. One is SPY, which charges an expense ratio of 0.09%. The other is VOO, which charges 0.03%. Same index, same stocks, same exposure. The only difference is cost. The median ETF expense ratio is about 0.5%. SPY already looks cheap at 0.09%, roughly 81% below the median. VOO is even cheaper at 0.03%, about 94% below the median. That difference looks too small to matter, so most investors ignore it. But once you move away from broad index ETFs, fees climb fast. Many thematic and actively managed ETFs charge around 0.75 to 1%. For example, ARKK charges 0.75%, ICLN charges 0.4%, TQQQ charges close to 0.8%. These aren't obscure funds. They're widely owned and often show up in portfolios that started with low-cost ETFs. By the time an investor has moved from broad exposure into trends, the 1% range becomes normal. So on $2,520, an ETF charging around 1% costs you about $25 per year in fees. Over 5 years, that's $125 gone in direct costs. And that money doesn't just leave, it stops compounding. Even with conservative growth, the loss compounding adds about $100 more over the same period. On top of that, higher cost ETFs often lag slightly because of turnover, cash drag, and tracking differences. Even a small performance gap adds another $195 over time. About $125 in direct fees, about $100 in loss compounding, about $195 from performance drag. That's roughly $420 gone. So that $2,520 slowly shrinks to about $2,100. At this point, the portfolio is smaller, but it still feels intact. And when money feels fragile, most people don't think about risk more carefully. They try to make it feel safer. That's where the next mistake comes in. What goes up comes back down. I'll walk through a few more mistakes like this, and by the end, I'll show you how the same $5,000 can either fall to about $700 or grow to roughly $7,000, a $6,300 difference created by decisions that feel harmless at the time. A lot of investors assume an ETF is diversified just because it holds a lot of stocks. The logic feels obvious. More holdings must mean less risk. That assumption is wrong. Take the iShares US Technology ETF. On the surface, it looks diversified. It holds over 140 companies, which sounds spread out. But when you look under the hood, almost 90% of the fund is in one sector, technology. And a huge chunk of that money sits in just a few names. Nvidia alone is about 17%. Apple is roughly 15%. Microsoft is over 12%. Add a few more mega-cap tech stocks and the top positions dominate the entire ETF. So even though there are dozens of holdings, the outcome depends on a small group of companies all tied to the same theme. When tech is strong, everything rises together. When tech weakens, nothing inside this ETF balances the damage. It all falls together. If you look at how tech has behaved across real market cycles, deep pullbacks are common. During the dot-com bust, the Nasdaq fell close to 78% from peak to trough. That's the extreme case. More recently, in 2022, tech didn't collapse, but it still took a serious hit. The Nasdaq 100 fell about 33%, and many growth-heavy tech ETFs dropped 40 to 50% from their highs as rates rose and valuations reset. That's why a 45% decline is a reasonable assumption here. It's not a worst-case scenario. It sits right in the middle of what concentrated tech exposure has already done in normal cycles when conditions change. So after herd mentality, trend hopping, and fees, the original $5,000 is already down to about $2,100. That remaining money is now concentrated in tech just as the sector starts to lag. A 45% decline on $2,100 is a $945 loss. Instead of one dramatic drop, assume it plays out over time as underperformance, roughly $189 per year. Here's how that looks in real numbers. You start with $2,100. After year 1, you're at $1,911. After year 2, $1,722. After year 3, $1,533. After year 4, $1,344. By year 5, you're left with about $1,155. And that's the dangerous part. Because at this stage, most investors don't think, I took too much risk. They think, I just need to spread this out a bit more. So they start adding ETFs, more funds, more tickers, different names that all sound like diversification. But when those ETFs are built around the same sectors, the same stocks, and the same trends, nothing actually changes. Everything still moves together. The labels are different, the risk isn't. And that belief that owning more ETFs automatically means less risk is what leads straight into the next mistake: diversification. Most investors think owning multiple ETFs means they're diversified. It doesn't. Diversification isn't about how many ETFs you own, it's about what's inside them. You can hold several ETFs with different names that all own the same US growth stocks and the same sectors. On paper, it looks diversified. In reality, everything moves together. So essentially, you've created leverage. A portfolio holding SPY, QQQ, and a tech ETF like IYW feels balanced, but when markets pull back, the same large stocks drive all three lower at the same time. When multiple ETFs own the same stocks, small market moves don't cancel out. They stack. A normal 5% pullback in those big names doesn't hit one position, it hits everything at once. If the market has a normal 5% pullback in those large growth names, it doesn't feel like a 5% event in this portfolio. It shows up again and again across overlapping positions. One fund drops 5%, another drops 6%, another drops 5% again. That's how a normal market move turns into something much larger at the portfolio level. Over time, that kind of overlap easily adds up to a 20% total decline, not from one bad year, but from the same risk of getting hit repeatedly. After herd mentality, trend hopping, fees, and concentration risk, that original $5,000 is already down to about $1,155. A 20% decline on $1,155 is $231. And this is where the frustration really sets in, because from the investor's point of view, they did everything right. They bought ETFs, they added more, they thought they were reducing risk. Instead, they accidentally increased it through hidden leverage. You started with $5,000. After common ETF mistakes and a lack of true diversification, you're left with less than $1,000. At that point, patience feels pointless, and they start over-trading to fix things. Over-trading starts with frustration, not greed. You watch your ETF swing up and down and feel the urge to fix it. You trade to regain control, then you trade again. Highly volatile ETFs like TQQQ intensify this behavior. With 3x leveraged exposure to the Nasdaq 100, TQQQ moves sharply in both directions. The chart displays repeated rallies and pullbacks, generating consistent signals that appear tradable. So investors jump in and out, trying to time short-term moves. Research shows this behavior consistently hurts returns. A large study of 66,000 households found that the most active traders earned about 11.4% per year compared to 18.5% for the broader market, a gap of roughly 7.1 percentage points, even before trading costs. To stay conservative, assume just a 1% annual drag from overtrading. On a portfolio already down to $924, that's about $9 per year. Over 5 years, that's what would reduce your investment from $924 to $879. And after all of that, there's one last mistake that finishes the damage, and that is not using stop-loss orders. A stop-loss isn't about predicting markets, it's about defining risk. Without one, you're exposed to sudden shocks and prolonged weakness that unfold faster and last longer than most investors expect. Take SLV, the iShares Silver Trust ETF. Over a recent period, it fell 28.5%, just holding through volatility without a defined exit. At this stage, after the earlier mistakes, the portfolio is already down to $879. Without a stop loss, that entire drawdown is absorbed. And the damage doesn't stop there. After major declines, assets that remain weak often continue to drift lower, not through another crash, but through persistent underperformance. A 5% annual decline is conservative in these conditions. It reflects ongoing weakness, not a new crisis. Here's how that erosion plays out. You start with $879. After year 1, you're at $835. After year 2, $793. After year 3, $753. After year 4, $715. After year 5, you're left with $679. So you started with $5,000. You didn't use leverage intentionally or options. You made common ETF mistakes, and by never defining downside, the portfolio falls below $700. That isn't bad luck. That's a risk that was never managed. Now, imagine the same $5,000, but with discipline. In the discipline path, you ignore noise instead of chasing performance. You stay diversified instead of trend hopping. You choose low-cost ETFs, balance exposure, research what you own, trade less, and define risk before markets force your hand. Historically, broad market ETFs that track indexes like the S&P 500 have delivered long-term returns of roughly 6 to 7% per year after inflation, if you start with $5,000 and just stay invested. After year 1, you're at about $5,350. After year 2, it grows to roughly $5,725. After year 3, you're around $6,125. After year 4, the balance reaches about $6,555. By year 5, you're sitting at roughly $7,000. Now look at the other path. The same $5,000 eroded by herd mentality, trend hopping, unnecessary fees, concentration risk, poor diversification, overtrading, and unmanaged downside shrinks step by step to under $700. Same market, same tools, very different outcomes. That's a difference of over $6,000, created entirely by behavior. ETFs are powerful tools. They amplify how you use them, chase performance, and they punish, overpay, and they bleed, ignore risk, and they expose you, respect them, and they compound in your favor. Want to know how I would build a portfolio in 2026 if I had to start in 2026? Click the video on screen to find out.